Hey, good afternoon. The Fed is already back in the headlines, even between these meetings. We've got retail sales earnings, plus the question of the week all about I bonds. So, very timely inflation bonds. My name is Brandon Steele, financial advisor with Mainsail Financial Group here in Bellevue. And our goal every Thursday is to bring to you the market news, the data, the trends, the things that we're watching, and hopefully weed out a little bit of the noise along the way. So let's just start with the Fed because, as always, and especially recently, they're back in the headlines. So Tuesday, the Fed had an interview, and the gist of it was they basically said they're going to throw the kitchen sink at this inflation thing. I mean, they basically said they know this is a big problem and they're going to do everything that they can to tame it. Um, so, well, before I get to the market's reaction, on top of that, Tuesday we had retail sales at 0.9%. But retail companies were reporting earnings. Walmart, Target were the two biggest ones that you might have seen in the headlines, and they were not so great. Say a huge impact on the markets between this and the Fed. So Tuesday, when the Fed announced this, there really wasn't much of a reaction, and then Wednesday the markets sold off big. So Wednesday, I think the S&P was down a little over 3%, almost 4%. So we saw a huge impact on this combination of factors in the market on Wednesday, after a bit of a rally recently too. So we felt like, it's like finally we get a little bit of steam and then shoot right back down. This is going to be really important to watch. Obviously, the Fed has time and time again laid out their plan. Now, they didn't say exactly what they're going to do, but they did say that they're going to do everything they can. So we'll see. I think they will. As we get closer, we get the minutes next week. And I think as we get closer, they'll start to outline more of what's coming. One of the biggest things with the retail sales earnings was that the company's inventories were up big, which led to a lot of these concerns. So obviously something to keep an eye on there. Housing market data was a little bad this week too. We had building permits at 1.82. We had housing starts slightly lower than expected. Fast forward to today, and we had existing home sales at 5.61 million, which was less than expected as well. So a little bit of crack in what has otherwise been an amazing housing market lately too. Today we had initial jobless claims come out at 218,000. And real quick before we get into our question of the week here this week, which is all about I bonds. Coming up next week, the Fed will be back in focus again. As I mentioned, the minutes are going to come out next Wednesday. So as you might imagine, we will be spending a lot of time on the Fed again here. I imagine they're going to kind of roll out their plan for the upcoming meeting in June, I believe it is. So get ready for that. We'll make sure to break that down as we gear up for next Thursday's session. But before we break today, our question of the week is a great one, which is about inflation bonds or I bonds. And these instruments, let's call them, are picking up a lot of steam. Now, I'm not here to say they're right or wrong, but what I wanted to touch on is what they are generally speaking. So generally, an I bond or an interest bond is a treasury bond, okay? It's from the US government, but what it does is it ties to the inflation rate. And so what you will get when you purchase an I bond, if you purchase an I bond, is a fixed rate and then an inflation rate that applies to that, and that is adjusted every 6 months. So depending on where inflation is, you can get good interest rate off of these types of bonds during a period like now, but when it's lower, obviously not so appealing. Okay. Now, the way that this works, again, they're repriced every 6 months, but one of the biggest things that I think is important to note, two biggest things. Number one, it's a 30-year maturity. So these bonds are 30-year bonds when you buy them. Number two is that there is no secondary market for trading I bonds. So all of these bonds must be bought and sold directly from the US government, okay? The interest does not pay as it goes. It's all accumulated, and you only receive that interest when you cash out. All right. So if you hold it for 30 years, obviously you can see where, especially when lower inflation starts to kind of factor into there, it may not be as exciting as it may seem on the surface today. Another thing to consider is that you have to hold it for 1 year, but you also have to hold it for 5 years to receive the full interest payments. Okay. So this is also really important. You can also only buy, I think it's 10,000 a year. You can also use some tax returns, so possibly up to 15,000 a year. But that's all you can buy with I bonds as well. So I'm not saying that they're bad in nature, but I think it's we've seen a lot of headlines about I bonds, but in reality, do they work as well as it might seem just in this period? We will see, I guess, as time goes on, but there are limitations in how you can buy them, where you can buy them, how you can sell them, where you can sell them, and also obviously, keeping in mind that there are some holding periods that we need to adhere to as well. So great question of the week. I'm really glad we got to touch on that with everything going on with inflation lately. Join us next week. We're going to break down the Fed's minutes that come out on Wednesday, which will be very, very telling. And for those who are not registered, we are also hosting a online learning session this evening. It might be very last minute, obviously, but definitely let me know if you want to join and I can send you the registration link. It's this evening at 5 p.m. Have a great night. We'll see you next Thursday at 3.